If you have money invested right now, there's a real possibility you're inside a financial bubble. And here's the problem. Bubbles don't feel dangerous. They feel exciting. They feel smart. They feel like momentum. Your portfolio is rising. Everyone is optimistic. The news is positive. Experts are confident. And that's exactly when risk is highest. Because bubbles don't send warnings. They collapse when confidence shifts. And by the time headlines confirm the crash, most of the damage is already done. The real question isn't whether bubbles burst. They always do. The question is, will you lose money when this one does? Today, we're breaking down how financial bubbles form, how they trap investors, how interest rates and liquidity fuel them, and most importantly, how to protect your investments before the collapse begins. Block by block. And there's one mistake investors repeat in every bubble cycle. We'll get to that. A financial bubble starts quietly. It doesn't begin with chaos. It begins with opportunity. Maybe a new technology emerges. Maybe central banks cut interest rates. Maybe liquidity floods the financial system. Money becomes cheap. Credit expands. Investors take more risk. At first, the gains are rational. Asset prices rise because fundamentals improve. But then, something shifts. Prices begin rising faster than earnings, faster than productivity, faster than real economic growth. And that's when valuation detaches from reality. Low interest rates are often the spark. When borrowing is cheap, investors use leverage. Margin accounts expand. Businesses borrowed to buy back shares. Real estate investors use financing aggressively. Cheap money increases demand for assets. Increased demand pushes prices higher. Higher prices attract more investors. Momentum builds, liquidity feeds speculation. This is how bubbles inflate. Then psychology takes over. Fear of missing out replaces discipline. You see others making money, you feel latchy, you increase your exposure. You buy assets not because they're undervalued, but because they're rising. This is the acceleration phase. And during this phase, risk feels invisible, but leverage is growing. Concentration is increasing. Valuations are stretching. The structure becomes fragile. Now here's where most people make the fatal mistake. They assume price equals safety. If the stock market is rising, they believe risk is decreasing. But in reality, risk increases as valuations expand. The higher prices go above fundamental value, the thinner the support underneath them. Bubbles are not dangerous at the bottom. They're dangerous at the top. And the top feels the safest. Let's talk about leverage. If you invest with borrowed money and the market drops 20%, your losses are amplified. If you are using margin and prices fall sharply, you may face a margin call, a forced liquidation. That means selling at the worst possible moment. Leverage turns volatility into destruction, and bubbles are full of leverage. So what causes the burst? Liquidity tightening. Central banks raise interest rates to fight inflation. Credit becomes more expensive. Economic growth slows. Earnings expectations weaken. The first wave of smart money exits quietly. Prices stall, then decline. Retail investors hesitate, then panic. Selling accelerates. And once fear replaces greed, the unwind is violent. Most investors don't lose money because bubbles exist. They lose money because of positioning. Too concentrated in one asset. Too much leverage. No liquidity. No risk management. Emotional decision-making. The mistake investors repeat in every bubble cycle is this. They manage upside aggressively and downside emotionally. That inversion destroys capital. So how do you protect yourself? First, understand valuation. If asset prices are rising far faster than underlying earnings or economic growth, risk is increasing. Second, control position size. No single asset should dominate your portfolio simply because it performed well. Third, if one asset grows from 20% to 50% of your portfolio, risk has doubled. Selling part of it locks in gains. Yes, it feels uncomfortable, but discipline protects capital. Liquidity is power. During bubbles, being fully invested feels smart. During crashes, liquidity feels priceless. If you hold some cash or defensive assets, you gain flexibility. Flexibility allows opportunity. When markets crash, quality assets go on sale, but only those with liquidity can act. Diversification reduces fragility. Different asset classes respond differently to economic cycles. Stocks, bonds, real estate, commodities, cash. Inflation affects them differently. Interest rates affect them differently. A diversified portfolio absorbs shocks better than concentrated speculation. Now, let's connect this to the financial system. Bubbles often form during periods of low interest rates, expanding credit, high liquidity, strong investor confidence, and they burst when interest rates rise. Credit tightens, liquidity contracts, confidence shifts. Understanding macroeconomic signals reduces surprise. You may not time the exact top, but you can see risk building. And here's the final truth. You don't need to predict the exact moment a bubble bursts. You only need to avoid being overexposed when it does. You don't protect capital through prediction. You protect it through structure, controlled leverage, disciplined allocation, liquidity reserves, emotional neutrality. Markets move in cycles. Greed builds bubbles. Fear bursts them. But disciplined investors survive both. And once you see the structure clearly, you stop chasing momentum blindly. You stop managing risk intentionally. Because bubbles punish excess and reward preparation. But there's something even more dangerous than buying into a bubble. It's believing you can outsmart it. Many investors say, I'll just sell before it crashes. That sounds logical, but here's the problem. You don't recognize the top while you're in it. At the peak of every bubble, confidence is highest. Economic data still looks strong. Earnings still look acceptable. Analysts still publish optimistic targets. And prices still climb. The turning point doesn't announce itself. It begins quietly. A few failed breakouts, a few weak earnings reports, liquidity tightening slightly, and then momentum slows. Most investors ignore early warning signs because they're small. By the time signals become obvious, prices are already falling fast. That's why timing bubbles is almost impossible. Structure beats timing. Let's run a practical scenario. Imagine you invest $100,000 into a fast-rising stock market during a bubble. Prices surge 40%. Your portfolio grows to $140,000. Confidence increases. You feel validated. Now imagine the bubble bursts and the market falls 35%. Your portfolio drops from $140,000 to $91,000. You didn't just lose the gain. You lost part of your original capital. To recover from that loss, you now need a gain of over 50%. Losses require bigger gains to recover. That asymmetry is brutal. Protecting capital matters more than chasing peaks. Now consider leverage inside that same scenario. If you used borrowed money to amplify your position, a 35% decline could wipe out most of your equity. That's how margin calls accelerate crashes. Forced selling increases supply. Increased supply pushes prices down further. It becomes self-reinforcing. Bubbles burst violently because leverage amplifies fear. Let's connect this to interest rates and monetary policy. When inflation rises, central banks often raise interest rates. Higher interest rates increase borrowing costs. Higher borrowing costs reduce speculative activity. Speculation decreases. Demand slows. Asset prices stall. If valuations were already stretched, even small tightening can trigger a correction. Bubbles thrive on cheap money. They weaken when money becomes expensive. So watching interest rate policy gives you context, not prediction. Context. Now let's talk about concentration risk. Many investors unknowingly become concentrated during bubbles. They don't start concentrated. But when one asset rises rapidly, it grows into a larger percentage of their portfolio. A position that started as 15% can become 45% without adding new capital. That changes risk automatically. If that asset collapses, your portfolio collapses with it. Rebalancing forces discipline. It forces you to trim exposure. And trimming during euphoria feels wrong, but it protects long-term wealth. Here's another behavioral trap: narrative attachment. During bubbles, stories become powerful. This technology will change the world. This market can't fail. This is the future. Narratives reduce skepticism, but markets price in perfection during bubbles. And perfection is fragile. When expectations are too high, reality doesn't need to be terrible. It just needs to be slightly disappointing. And slightly disappointing can cause sharp Now think. Long term, if you lose 40% during a crash, your future compounding slows dramatically. Even if markets recover, time loss matters. Capital lost in early years reduces exponential growth later. Avoiding large drawdowns is one of the most important principles of long-term investing. Not because crashes are permanent, but because recovery takes time. And time is the most valuable compounding asset you have. So, how do you stay rational when everyone else is You create rules before emotions rise. You define maximum position sizes. You define acceptable valuation ranges. You define how much leverage, if any, you tolerate. You define your liquidity buffer. You prepare during calm periods. Because once volatility spikes, emotions override logic. Preparation prevents panic. Let's visualize it with blocks. Imagine a tall tower built from investment blocks. As prices rise, you keep stacking blocks higher. But the base remains the same width. Achisomi point. The tower becomes unstable. The higher it grows without widening the base, the more fragile it becomes. Diversification widens the base. Liquidity strengthens the base. Risk management stabilizes the structure. Speculation only increases height, and height without foundation collapses faster. Here's the final layer most investors ignore. You don't need to avoid every bubble. You need to survive them. Markets will always cycle between optimism and fear. Interest rates will rise and fall. Liquidity will expand and contract. Inflation will pressure central banks. Recession risks will emerge. But disciplined investors who control leverage, manage exposure, and maintain liquidity don't fear bubbles. They respect them. And respect reduces damage. Because in investing, survival is power. Capital preserved today becomes opportunity tomorrow. When others are forced to sell, disciplined investors can buy. That's how wealth transfers during crashes. From overexposed to prepared. And preparation is built before the burst. Block by block,